Joining me now, Anderson Capital Management Chief Investment Officer Peter Anderson. And joining the conversation all morning long, former Assistant Secretary of the Treasury for Public Affairs, Monica Crowley, and Mahoney Asset Management CEO Ken Mahoney. Welcome, one and all. Great to see all of you. Peter, what do you expect to see in the markets in the coming week, just given still the existing potential that Putin invades Ukraine?
Well, it's been I very much appreciate that we have this three-day weekend, because the data has been coming in so rapidly that it's very, very hard for investors, I think, to catalyze all that data. And going forward, I don't see much of a change, Dagan. You know, we've got three main factors that you have to look at in isolation at first. And I think a lot of investors are so confused because they're mixing all these factors. So let me just summarize them for you. Of course, we have COVID, right? We have the interest rate discussion, and we also have the Ukraine situation. When you look at those in isolation, they're tough enough to try to figure out how you should invest. But then when you mix them all together, no wonder everybody is really confused at this point. So what I try to do is look at those things in isolation, gather opinions and hypotheses about all those three things, mix them together, and then you have a market outlook.
What is that outlook?
The outlook is that I think in COVID, most of us are acting like it's gone, although the market has not acted like it's gone. But I do think that we are at the waning point of COVID, so that is a good thing. I think with the Fed, the rate outlook has to be dependent also, though, on COVID and the Ukraine situation. So that's kind of a very fluid situation right now, as is the Ukraine. However, with all those three factors involved, I do think if you have the courage to stay invested, I know many people have said this in the past, but I do have to repeat it. If your thesis hasn't changed and your horizon for investing is the same, you do have to be optimistic and somewhat of a risk taker and say to yourself, if I liked the stocks before all these three factors, then I should like them as we work through the resolution of those factors.
Ken Mahoney, jump in here.
So again, great to hear that voice of reason, Peter, especially where there's so much volatility and angst and so forth. And look, I hope we can resolve this Russia-Ukraine. I guess we'll know more today. But let's say we get past this hurdle. You're concerned about the Fed. Remember, the Federal Reserve has whipped a number of times, like fourth quarter 2018, telling us that we're going to raise rates only to have an emergency rate cut. Are you worried longer term that they're going to throw us into recession with too many rate hikes? And how would that throw off your thesis?
Well, one of the things I actually did look at to calm my own nerves about this is I did look at the past 5 rate hike cycles. And I think it's all very worthwhile for us to do, all of us to do that. And when you look at those 5 cycles, 4 of the 5 cycles, all 3 major indices have done very well, 20% plus returns. That's the NASDAQ, S&P, and the Dow Jones. That also gives me a little bit more comfort that all this talk about with rising rates, that growth stocks should take it on the chin. Factually, when you look back, 4 of those 5 times, that just hasn't happened. In fact, of the 4 of the 5 times, the NASDAQ has been very, very competitive with the S&P returns. So that's how I put myself to sleep at night, as I think about those 5 times that rates have been raised, and that 4 of the 5 we've done very, very well. I'm hoping for this next cycle. And of course, I do think the Fed will raise rates, but I think it's a fool's errand at this point to try to project how many rate hikes there'll be in a year, simply because of those 3 factors I mentioned at the beginning of this segment, is that it's a dynamic situation, and I do have great faith that the Fed will be, as they've always said, data dependent, but also scenario dependent, so that they will
Peter,
be reasonable.
they've got a $9 trillion balance sheet that they've got to unwind. It's never been that size. It is done, you know, and they waited, what, 2.5 years after the financial crisis in 2008 to begin winding down the balance sheet, or trying to reduce it, and removing that supply of money and destroying money, which is what the Fed should do. Investors don't know. They have no way of knowing what the impact will be on markets. And I'll just point out that we get the personal consumption expenditures out on Friday, key gauge of inflation for the Fed. It's going to give a better read on the extent of the price increases across the economy. JP Morgan economists are expecting their rate hike expectations. They say the Fed's going to likely raise interest rates by 25 basis points, 9 straight hikes. That would take it to 2.25% by March of 2023. But my point is this is way beyond just interest rate hikes. This is about balance sheet reduction and what the Fed does on that, and whether Jay Powell takes this inflation that's hurting so many hardworking Americans, whether he takes it seriously or not.
Well, let me respond to that. I do agree with all the points you've mentioned, and I don't mean to trivialize how difficult these steps are. I would add, however, that this is a very unique time when we compare it to 2008, for instance. The fact that we were in a global pandemic certainly does throw a monkey wrench into any past actions and rationale the Fed has used. So while it's a very difficult step to take, given the current environment, I do think that a 50 basis point hike is just out of the picture for the first round, simply because it's too strong. We're trying to dip our toe into the water rather than jump into the deep end of the pool. And so I think that would just flip everybody out if 50 basis point hike were the first one. Perhaps later on there will be. And certainly the balance sheet is a major gorilla in the room when we talk about this. But I can't think of any other way for a Fed to move forward without causing additional anxiety and adding a fourth factor, perhaps, to this crazy market that we're in right now.
Peter Anderson, thank you so much for being here. We'll see you again soon. We're just getting started this morning. Coming up.